All right, let's dive in. Today, we're going to tackle one of the biggest accounting changes in decades. And look, before your eyes glaze over thinking this is just for accountants, you've got to stick with me. This is all about understanding what's really going on with a company's finances. And it all starts with uncovering a multi-trillion-dollar secret that was hiding in plain sight for years.
So let's just start with a number that's, well, it's just staggering. $2 trillion. That's the estimated amount of corporate debt that was essentially invisible. We're talking about the commitments companies made to pay rent for their planes, their stores, their equipment, all of it. And for decades, it was totally legal to keep this stuff off the main financial statements, which you can imagine created a massive blind spot for anyone trying to figure out how much a company truly owed. And this wasn't some tiny little accounting quirk. I mean, get this. Financial regulators themselves basically said that under the old rules, even the experts, the pros, had to take an educated guess. They were literally in the footnotes trying to estimate a company's true debt by taking its annual rent expense and multiplying it by maybe 7, maybe 8. The whole system was kind of broken, and it was definitely time for a major fix.
So the big question is, how on earth did this happen? How did $2 trillion in obligations just disappear? Well, it all came down to this idea called off-balance sheet financing. It was perfectly allowed under the old rules, ASC 40 in the US and IIS 17 for the rest of the world. So let's unpack exactly how this giant loophole worked. You see, the old system was basically this all-or-nothing game. A lease was either a capital lease, which was treated like debt and put right on the balance sheet for everyone to see, or it was an operating lease, which stayed off the balance sheet buried deep in the footnotes. And the problem was there were these very specific bright-line tests to decide which was which. For example, if a lease term was 75% or more of an asset's useful life, it had to go on the books. So what did companies do? You guessed it, they'd write a contract for, say, 74%, just barely missing the cutoff, and poof, billions in obligations just vanished from the balance sheet. Right, so to fix this, the new standards, ASC 842 and IFRS 16, came in with a really simple but honestly a really powerful idea. They said, look, a lease does two things. It gives a company something valuable, the right to use an asset, and it creates a promise to pay for it. Both of those things, the asset and the liability, belong on the balance sheet, period. And to do this, they introduced a new term, the right of use or ROU asset. I know, it sounds like more accounting jargon, but it's actually super intuitive. When a company leases a building, it has the right to use that building, right? That right is a real asset. And of course, to get that asset, the company takes on a lease liability. And that liability is just the present value of all the future rent payments. In other words, what's that whole stream of future payments worth in today's dollars?
So here's where it all clicks. Imagine two airlines. Airline A buys a plane and takes out a huge bank loan to do it. Airline B leases the exact same plane for 15 years. Economically, their situations are almost identical, right? They both control a plane and they both have a massive obligation to pay for it. The new rule simply says their balance sheets should reflect that same reality, finally ending the accounting game that made the leasing airline look way, way less indebted than it actually was. Okay, so we've got the why. Now let's get into the so what. How does this rule change actually mess with the financial statements we all look at? Because, trust me, when you suddenly dump billions of dollars in new assets and liabilities onto a company's balance sheet, it changes all the key numbers we use to figure out if it's healthy or not. And this is where things get really interesting, because there was this huge split between the US and pretty much the rest of the world. Everyone agreed to put the leases on the balance sheet, but they couldn't agree on how to handle the expense on the income statement. Internationally, they split the old rent expense into two new parts, depreciation and interest. And since those two things are taken out when you calculate the super popular EBITDA metric, it actually makes EBITDA go up. Meanwhile, in the US, they kept it simple for operating leases, and EBITDA isn't affected at all. Think about that. Same company, same lease, but different profit numbers, depending on where they report. And you can see the ripple effect right here. For any company that leases a ton of stuff, we're talking airlines, big retailers, telecom companies, their balance sheets just swelled up overnight. Assets shot up, but so did liabilities. That means their debt-to-equity ratios jumped, making them look more leveraged. And at the same time, because their total assets are now bigger, ratios like return on assets went down, which can make them look less efficient, at least at first glance. But here's the twist, and it's a really important one. While that old massive loophole was slammed shut, the game didn't just stop. It just evolved. The motivation to keep big obligations off the balance sheet is still very much there, and some new, clever strategies have popped up.
So that leads us to the big question, right? Is everything on the books now? Is the problem solved? Well, not exactly. These new rules are what we call principles-based, which means there's some gray area, some room for interpretation. So let's look at the two main ways companies are navigating this new world.
The first one is a biggie: variable lease payments. The rule says that if a payment isn't fixed, if it depends on something like future sales or how much you use an asset, it doesn't have to be included in that big lease liability number up front. The second strategy is playing with the line between a lease and a service contract. See, it only counts as a lease if you control a specific asset. So if a provider can just swap out the equipment whenever they want, a company can argue it's just a service contract, which keeps the whole thing completely off the balance sheet.
And this isn't just theory. Look at this real-world example from Southwest Airlines. Back in 2018, a stunning 77%, almost all of their lease costs were variable. These are payments tied to things like how much passenger traffic an airport gate gets. Now, those are very real commitments, but a huge chunk of them are excluded from that main lease liability number on their balance sheet. The hidden leverage is still there, it just has a new hiding place.
So what does all of this mean for us? Well, it brings us to the most important takeaway of this whole thing. This new standard didn't make analyzing a company simpler. If anything, it's made it more sophisticated. True financial intelligence now means you've got to dig deeper than ever before. So now, if you really want to understand a company, you can't just glance at the balance sheet anymore. You have to be a detective. You got to dig into the footnotes and start asking some new, smarter questions. Like, how big are those variable lease payments really? What discount rate did the company use? Because a small change there can shift the liability by millions. Are there some huge service contracts that look and smell an awful lot like leases? And are there bank loans using something called frozen gap, which means their lenders are still judging them based on the old rules? At the end of the day, what's really happened here is a shift in focus. We've moved away from just looking at reported debt and toward understanding a company's total adjusted economic obligations. And the truth is, the really smart people at credit rating agencies like Moody's and S&P were already doing this. They were estimating lease debt long before the rule change. The new standard just gives them, and all of us, way more precise data to work with.
So you see, this whole change wasn't just some boring compliance exercise for accountants. It forces us, as investors, as analysts, as anyone who cares about a company's health, to ask a much deeper, more fundamental question. What really counts as debt? The line between a simple rental payment and a loan payment has been completely redrawn, and the answer isn't just a single number on a balance sheet anymore. It's found in the footnotes, in the company's strategy, and in understanding the true economic promises a company has made. And knowing how to find that is the new standard of financial clarity.